Donna. Hi, my name is Shamika Gladney, and I run the New Market Tax Credit Program here at Enterprise. Thanks for joining the webinar today. I'm really excited to talk with all of you about this topic. So this tax credit training will actually cover both new market tax credits and historic tax credits. I'll also talk a little bit about the current policy environment for the new market tax credit program. We'll start off first by talking about the new market tax credits. A bit of background. This program was created by the Community Renewal Tax Relief Act of 2000. It's Section 45D of the Internal Revenue Code. The New Market Tax Credit Program is administered by professionals within the CDFI Fund. It talks about the purpose of the program. The tax credit was envisioned as a way to incentivize or motivate private capital to flow into low-income communities. The idea is that if you have a dollar to invest and you have to decide between investing that dollar in a low-income community versus a non-low-income community, and your focus is on your return on investment, you may be steered toward a non-low-income community because you may have a greater return there. So the idea here is that if there were a tax credit to help increase the return that you would receive if you invested that dollar in a low-income community, then perhaps that would be enough motivation to get you to do so. This credit is a 39% tax credit. It's taken over a 7-year period. It's 5% credit for the first 3 years and then 6% for the next 4 years. There are a couple of different entities that are involved in your typical new market tax credit transaction, and I will walk through those with you. This program does have a lot of nomenclature that's specific to new markets and a lot of sort of acronyms. The first one is the one you'll see here, which is CDE. A CDE is technically the entity that applies for an allocation of federal tax credits, and that'll make a little more sense as we go further along in the presentation. Investor is the one that receives the credits. The investor receives the credits by making investment into a CDE, and that CDE makes an investment into a qualified business in a low-income community. Let's get to the slide. So Enterprise applies for and receives allocation authority from the CDFI Fund. We form partnerships with investors, and in conjunction with investors, we make investments into qualified projects. This week, some of you may have participated in a similar webinar for low-income housing tax credits. This program is quite a bit different from the low-income housing tax credit and the ways that you'll see here. The low-income housing tax credit, as most of you probably know, is it helps produce residential development for people who are at below a certain income. The new tax credit program is more flexible than that. It can be used for a number of different types of projects, and we'll talk about some of those later on in the presentation. New market tax credit is primarily place-based. There is a little bit of an exception to that does allow certain investments to be people-based, and I can talk about that further in the presentation. Entities like Enterprise and others that are community development entities, or CDEs, are the ones that control what projects the new market tax credits are put into. Full year of credit on the day of the investment. That's also a difference between the two programs. Tax credits are also a little bit different in the way that they are allocated. The new market tax credit is, it's not equated to the total development cost. A lot of times you will see projects that have new market tax credits, but the amount of tax credits that they receive or the allocation that they receive is not the total development cost of the project, and there's no eligible basis type calculation that's done in new market tax credits. It is an all-or-nothing program when it comes to the recapture risk. So volume for new market tax credits. So to date, there's been just over $50 billion of allocation awarded. The most recent allocation was awarded in, I believe it was in November of 2016. CDEs apply to the CDFI Fund for allocation, and those allocation application requests have totaled over $330 billion of tax credits. It's a really big number, but allocation authority and tax credits are not the same thing. I'll talk a little bit more in the presentation about the difference between those two, but essentially the amount of the tax credit is calculated based on the amount of allocation. So the actual tax credit amount is much, much smaller than the allocation amount. It's something that is important to take note of if you're new to the program. When thinking about how much allocation you need, the amount of allocation that you need does not necessarily equate to the amount of dollars that you need to fill the gap in your project. Those two numbers are slightly different. Or when talking about new markets tax credits versus the LIHTC credit, there are a number of different types of projects that new market tax credits can be used for. It is very often used for commercial projects and for real estate. It's non-residential or mixed-use real estate. The development in new market tax credit transactions have to have at least 20% of the gross income of the project generated by some sort of non-real estate use. It's not a program that can be used for developments that are 100% housing, or 100% rental housing, I should say. It is possible to use new markets tax credits for for-sale housing. It's not often done, but it is done, and if that's the type of project that you have, it is possible to use new market tax credits for that. Its tax credit can be used for new construction. It can be used for renovation. It can be combined with historic tax credits, and I'll talk a little bit about that at the end of the presentation. It's not typically combined with LIHTC, except if you have a building where you can separate the building into separate condo regimes. Then you can have a portion of the building that has LIHTC in the capital stack and a different portion, likely the commercial portion of the building, that has new market tax credits in the capital stack. So in that scenario, you can use both sorts of financing in one actual project or building. So this tax credit is a gap financing tool. It is one of the deal sources that can be used to help complete a project. It's definitely not the only source that's needed. In the most typical structure, which I'll take you through later, there is a debt component that's also used, and sometimes other sources in conjunction with the new market tax credits. But often when you're doing development in low-income communities, you may have some of the financing sources that you need, but there's still a gap. And new markets is a great financing tool for filling that gap. New tax credit equity, the actual dollars that you would receive, are typically between 20 and 30% of the total amount of new market tax credit financing. So if you have a project that has a gap of $3 million, then the gap that you need to fill, you would need roughly $10 million of new market tax credit allocation to get you to that 30%, which is the $3 million to fill your gap. To go through this phrase of how the program works, and I'm going to walk you through it a little bit later, and hopefully these may start to make sense for those of you who haven't heard them before. Credits are earned when a QEI is made into a community development entity, or a CDE. That CDE uses substantially all of the QEI to make a QALI, which is either a loan or equity investment, into a Qualis B, which is a qualified low-income community business. And those businesses are located in low-income communities. All of this nomenclature is very common in new markets. We use these names all the time. Hopefully by the end of this presentation, all of that will make sense, and I'll walk you through that in a little bit. Right now, before I would go into something like a deal diagram to talk about these things, I want to just break down some of these so that they make sense. Low-income community. So low-income community is one where the poverty rate exceeds 20%, or the median income is below 80%. It also be a targeted population. That is a circumstance where you can market tax credits, and the project doesn't have to be based on the location of the project, but it can instead be based on who the project benefits. An example would be if you had a Head Start facility that perhaps not located in a census tract where the poverty rate exceeds 20% or the median income is below 80%, but you could have a targeted population, meaning that you're serving the children and families that qualify for Head Start dollars, which are low-income families. So there's a way to use the program even if you don't have a project that physically is in a census tract that qualifies. Are, I would say, less than 10% of all the transactions that get done each year, so they're not super common, but they do happen. So equity investment, that is cash in exchange for ownership in the CDE. The investor in the transaction is the one that is making the qualified equity investment into a CDE like enterprise. The CDE then has to use substantially all of those dollars that they received from the investor to put into the project. Entities are entities like enterprise. There are several other CDEs, are developers, some are other community development entities, some are nonprofit, some are for-profit. All of them have a mission of serving low-income people. You have to show that you're accountable to residents of low-income communities, both by the work that you do and by your advisory board makeup. You have to be certified as a CDE by the CDFI Fund. CDFIs are automatically CDEs, but you do not have to be a CDFI to be a CDE. You just have to certify and get approved by the CDFI Fund. A QALICB. Now, a QALICB can be a loan or an equity investment to a qualified business. It can be a loan or investment to another CDE, or it can be financial counseling or another type of service. But the most often you'll see QALICBs as being either a loan or investment to a qualified business or a loan or investment to another CDE. And then what's a qualified business? So Qualis B, which is a term that we use a lot in new markets, is essentially the project. It is usually an LLC, a corporation, or a partnership, or some other, most often single-purpose entity, but it doesn't have to be a single-purpose entity that's engaged in the conduct of business in that qualified area. Active just means that it has to be reasonably expected to generate revenues within 3 years after the QALICB investment is made. So it can be a construction project as long as it doesn't have a construction period that's longer than 3 years, because you have to be able to show that you expect that project to generate revenues within 3 years. The requirements for a Qualic B are that at least 40% of the property has to be in a low-income community, or you can provide at least 40% of services to low-income communities, and you also have to generate at least 50% of your income in a low-income community. That a lot of times the way that projects qualify is because they're physically located in a low-income community, but there are some other ways to qualify. You do not have more than 5% of your property being non-qualified financial property, and you cannot have more than 5% of your property as collectibles. Businesses that are prohibited from being Qualic Bs, and this isn't at the discretion of the CDEs. This is required to be in compliance with the program. So some of the types of businesses that are excluded from being Qualic Bs and therefore are not eligible for new markets, regardless of where the project is located, are some of the ones you see listed here. Some of them are obvious, and some actually do require some discussion when you're looking at a project and whether or not it makes sense and qualifies for new markets tax credits. One that I've seen the most debate about is a liquor store. That terminology of liquor store, it's in the code, I believe, about the selling of alcohol for consumption off premises. But sometimes there'll be a project that, for example, is a grocery store, and the grocery store may serve wine or beer that's not meant to be consumed at the store. So that's a scenario where you do have to look at things like how much of the alcohol sales will be in comparison to what the non-alcohol sales will be, and really get your team comfortable that you're not running afoul of what was intended by the prohibition on the liquor store. That example is one that I've seen very commonly. Those projects do get done. Grocery stores do get financed with new markets very often, but that's one of the analysis that will have to be done just to make sure that isn't going to generate too much of its revenues from the sale of alcohol. Qualic B restrictions. You cannot be a business that develops or holds intangibles. There are certain farming businesses that are also excluded. That's an issue to talk to with either tax counsel or an accounting firm that's familiar with new markets, because there are starting to be some urban farming type businesses that do qualify. And then, like I said before, you can't use new markets to finance a project that is residential rental property unless you can show that at least 20% of their rental income will come from commercial uses. And that 20% test is a test that's done every year. So you have to be able to show that to believe that the commercial property will continue to generate enough income every year to be at 20% of the income generated by the total project. A couple examples of projects that Enterprise has invested in with our new markets tax credit allocation. I wanted to show these to you so you could just get a sense for the breadth of different projects, both in project type and geography, where new markets tax credits are used. I won't walk through the details on each of these projects, but I do think that they're great projects and great organizations, so I didn't want to do the projects a disservice by taking out some of the benefits of the projects and the description of the organization, so that's why it's a little lengthy, but I'll just give you sort of a high-level discussion on each one, and then you can feel free to read what's in the paragraphs below if you'd like. So Lighthouse School for the Blind. This is an organization, its name is somewhat self-explanatory. It's a nonprofit organization that's really focused on providing services to individuals who are blind and have low vision. They're based in San Francisco, and the new market tax credit allocation was used to help them purchase their headquarters facility, which is part of a mixed-use building, but they will own a condo in that building that covers, I believe, 3 floors. It allowed them to both have a permanent home and to expand and provide more services than they were able to provide in their previous home, which was much smaller. There are several different sources of financing, including the new markets tax credits. There's a bank loan, as well as donations and some support from the endowment of the Lighthouse School for the Blind. The project is a project with Greenpoint Manufacturing and Design, or GMDC. This is a project that was done in Brooklyn, New York. GMDC is a nonprofit developer of industrial properties. Their mission is to create and keep affordable industrial properties in the boroughs of New York. And this project was in Brooklyn, and it was used with a combination of other financing sources, including a grant from New York City and other local sources, as well as sponsor equity and debt from Enterprise's CDFI loan fund to finance the adaptive reuse of this building. The building was renovated and turned to spaces for tenants that GMDC provides these spaces to. They provide spaces that are as small as 1,200 square feet or as large as 7,000 square feet. And some of the tenants or types of tenants they have include woodworkers, metal finishers, home manufacturers, and other types of users who need industrial space and who would ideally like to be in the city, but industrial space is becoming expensive. And a lot of industrial properties in New York and in other parts of the country are being turned into residential. So this is a way to sort of keep some of those industrial properties industrial, keep the jobs close to where people live, and provide some affordable and long-term space for those types of businesses. Last project is the ARC3 in Washington, D.C. This is phase 3 of a project. The phases are in different buildings. This one used a combination of CDFI Fund debt, bank debt, a new tax credit allocation to build what will ultimately be, I believe, a 4-story building that will house several different nonprofit organizations, including Children's National Health System, a charter school that will be a private school that will be tuition free for boys, and Tree Institute, which is a nonprofit focused on childhood development, and they'll also have a daycare in the facility. Hopefully, those 3 projects show you the different types of projects that new market tax credits can be used to finance. The whole purpose of the program is to really be a gap filler for projects that are eligible and have most of their sources, but still have a gap that they need to fill, and new markets can do that. The BECs and the CDEs that are trying to find projects are focused on the types of community benefits that the project can provide, and we want to make sure that it's an efficient use of taxpayer dollars. Some of the cons are that there's a very strong competition, both for allocation amongst CDEs and also strong competition amongst qualified projects that have substantial community benefits, are located in the right jurisdictions, but there's more projects than there is available new market tax credit allocation. There are also some compliance issues that are particular to new markets and that must be followed and sort of paid attention to throughout the 7-year compliance period. So if you haven't used new markets tax credit as a tool before, some of those compliance issues may be new, and you'll have to get up to speed on some of those, and we'll talk about those later in the presentation. The transaction structures can also be costly and in some cases can be complex and in some cases costly. The benefit of the program is that it's a flexible financing tool, but one of the challenges with the program is because it's a flexible financing tool, there's sort of no sort of one-size-fits-all project or one-size-fits-all sort of solution to the problem. And so making sure that the project works for the requirements of the program can involve an accounting firm and lots of law firms, and that can drive up the cost sometimes. There's also some program renewal risk with the program, which I'll talk a little more about when we talk about the policy environment. There's a recapture risk. That risk is really borne by the CDEs and the investors, but they will require that individual projects sort of indemnify them for that risk. It is a 7-year compliance period for the new market tax credits, and recapture would be a capture of all the credits. So it's like enterprise play a role in your new market tax transaction by serving most often as the CDE. Enterprise will apply for allocation from the CDFI Fund. If we're awarded allocation, we can then add allocation to projects that are in need of new market tax credits to fill their subsidy gaps. Another important player in the deal is the investor and the lender. Now, sometimes a new market tax credit investor and the lender are the same entities. Other times they are different entities, and transactions are commonly done with the same investor and lender, and also very commonly done with different entities serving in those two roles. The lender is just like any other lender, focused on return of capital and return on their capital. The tax credit investor, if they're separate entities, is really focused on making sure that the project meets all of the requirements of the program so that they can continue to receive their tax credits and that there's no risk of those credits being recaptured. The investor in a new market credit transaction does not get any dollars back. What they get in exchange for their dollars is the tax credit over the 7 years. It's the sponsor or the developer. Of course, in charge of making sure the project gets built successfully. But one of the other things that's really important in just attracting allocation is to be able to really articulate the community impact and the community benefits of their program, make sure that they have all their sources committed, and begin conversations both simultaneously with CDs and investors, because there is a bit of a matchmaking process. Times there are projects that find a CDE, such as enterprise, and then an investor afterwards. Sometimes there are projects that find an investor first, and then an investor can help you find a CDE that might be a good fit for the type of project that you're working on. And so there is a bit of a matchmaking in that there are at least three entities that are going to be involved in your typical new markets transaction: the developer sponsor, the CDE, and the investor. And then if you have a separate lender, then that's a fourth entity that sort of needs to be involved in that matchmaking process. This slide just talks about the key risks that are evaluated when folks are looking at a particular transaction and weighing that transaction against other transactions. Some of these risks are the same risks that you would find in any real estate transaction, especially the ones at the top. Some of the other ones will be more particular to the new market tax credit program, including making sure that the project follows all IRS guidelines about the program, and then for each CDE, making sure that their allocation agreement with the CDFI Fund is being followed with the type of investment that they're making, and I can elaborate on that in a minute as well. Things like enterprise, get or compete for allocation with the CDFI Fund and other CDEs that are also looking for market tax credit allocation. As I said before, it's a highly competitive process. Of the ways that CDEs differentiate themselves is by to the CDFI Fund and articulating the mission and strategy behind their organization and how they plan on using the new tax credit allocation if they are awarded it. There are also when CDEs apply for allocation, they also a pipeline of potential deals or potential types of investments that they'll invest in. So CDEs are awarded allocation. They want to make sure that the types of projects that they invest in match up with the types of projects that they said they would invest in when they applied to the CDFI Fund. And they also want to make sure that the way they're using their allocation mirrors the mission and strategy that they articulated to the CDFI Fund when they received an award. Sort of making sure that that whole story makes sense. A lot of CDEs, enterprise included, have a particular time frame with which they want to deploy all of their allocation, and sometimes that time frame is different from the requirements of the CDFI Fund, which you want to show that you can invest in find good projects and invest in them in a timely fashion. So the ability to execute deal timing can also be important in addition to the community benefits and the reputation of the deal parties. First, I would say the primary concern is tax credit recapture and making sure that the project will run afoul of any of the IRS regulations so that the tax credits can remain protected. For lenders, the risk is a little bit different in a new markets transaction than it is in other types of real estate because the lender does not have a direct line to the actual physical real estate. There's not a mortgage securing the loan. What's securing the loan instead is the structure of the tax credit transaction. So the loan is secured by the investment in the QEI to the CDE, which is the one that made the investment to the actual physical real estate. So that is a little bit different from what most lenders are used to, and sometimes it can take a while to get a lender to sort of understand what their rates are and understand what their true risk is when they don't have a direct mortgage to the property. Section selection, CDEs like Enterprise and others usually have articulated to the CDFI Fund how they plan to use the allocation before they're even awarded the allocation. So different CDEs have different sort of strategies and both geographic strategies in terms of where they want to direct their dollars, and in terms of product type, they may have different priorities. So when you're a project and you're trying to find allocation, part of the challenge is figuring out what CDE makes the most sense for the type of project that you have. And unfortunately, a lot of that is trial and error. It requires talking to a number of different CDEs to determine if your project is a good fit for them based on a strategy that they've outlined for how they want to use their allocation. Speaking on our side, we like to show that not only are we being with what we said we do with the CDFI Fund in terms of the project type and strategy, but for an organization like Enterprise, that's a national organization, we also are interested in doing transactions that are spread out throughout the country. We'd like to see a mix of transactions, so we want to do some maybe focus on jobs, and then we might want to do some projects that may have a nonprofit sponsor. We may do some projects that are focused on healthy foods or healthcare. When it's sort of the different mix of projects, both in terms of the type of project and the types of community benefits that the project provides, but also in terms of sort of geographic location. So it's a bit of matchmaking to figure out if you're a project, how do you find the right CDE for you. The filter is always the community impact one. Community impact is really what drives whether or not, what drives how attractive your project seems to potential CDE. There's no sort of right or wrong community benefit, and some projects create different types of community benefits depending on what the project is. So there are some projects that may be huge job creation stories, but there may be some projects that are not huge job creation stories, but they may be great stories in terms of the goods and services that they provide to the community. So there's no sort of right or wrong answer when it comes to community benefits, but it is very important that you be able to clearly articulate what the community benefits are and sort of quantify what those benefits are. So, for example, if you're building a healthcare facility, how many more patients do you think you'll be able to serve each year? Are there types of medical services that you can't provide that you will be able to provide in your new location? Those are the types of things that CDEs will want you to be able to explain to them so that they can understand the benefit of the project to the community. Because the markets tax credit is really a gap filler. The CDEs will also want you to demonstrate that you have all the other sources of subsidy that you need, both that you have the other sources and that those sources are, if not fully committed, then very likely and coming into place. But you'll also want to make sure that there actually is still a gap there. Practitioners in the industry like myself, we view these dollars as being taxpayer dollars. It's not exactly what they are, but they're credits that these investors receive instead of having to pay more taxes. So we do want to make sure that the program is being used as efficiently and effectively as possible. So we do want to make sure that there actually is truly a gap there to be filled, and that the project wouldn't be able to proceed but for new markets. Compliance. Compliance is probably one of the things that is most unique about this program. Types of compliance. The project itself has to qualify, and we talked a little bit about how a project can qualify, both in terms of its geography, not having prohibited uses, and those types of things. CDEs also have to make that they stay in compliance as well during the life of the transaction. If CDEs aren't in compliance with IRS regulations, then that could cause a recapture of all of the tax credits. If the CDEs aren't in compliance with their agreements with the CDFI Fund, then they may suffer from penalties that the CDFI Fund can administer. So that's not a tax credit recapture, but it could be things like removal of the managing member of the CDE and other types of very serious outcomes. So the primary events of recapture from a CDE perspective are the three that you see here. Either a CDE ceases to continue to be a CDE, meaning that its primary mission and its board are no longer to the service of low-income people. It doesn't maintain the substantially all requirement, which is that 85% of the QEI, or the money it receives, is invested into a qualified project. Or CDE is redeemed or cashed out. So any of those things will result in a recapture, which is a loss of tax credits to the investor. The things here are not recapture events necessarily, including the QALICB B going out of business or the mortgage being foreclosed on. Instead, if the mortgage were to be foreclosed on, say the project was not performing and the CDE foreclosed on the property and was able to redeem some cash for that property, then the CDE is required to find a new project to invest in within a certain time period in order to still be compliant with IRS regulations. Talk a little bit about stuball. So that's the requirement that 85% of the QEI remain invested, and there are cure periods for that. Usually, the stuball requirement comes into effect sort of in 2 times. First is when the project is initially financed. Typically, the QEI and the QALICB will all be financed at once so that you don't have to worry about stuball beginning. And then you just have to worry about maintaining compliance. You don't have to worry about getting initially in compliance because you did that when you closed the transaction. Maintain compliance, that's a scenario where I talked about a minute ago where if there was a foreclosure and funds came back through a foreclosure of a mortgage, well, now you don't have you may not have 85% of the QAI invested in a qualified business anymore, so you have a certain time period to find a new project to invest in. Reasonable expectations protection with the new market tax credits. That's documented at the time of closing, and that's through tax opinions that you get from the lawyers, and that it supports that a QALICB B is a QALICB B when you close, and why it's reasonable to expect the QALICB B will remain a QALICB B during the 7-year compliance period. It's not a guarantee against recapture, but it is significant protection against recapture. So it's very important to have that documentation that talks about why the deal qualifies initially and why it's reasonable to expect the deal to continue to qualify during the 7-year compliance period. And the allocation agreement, those sort of last CDE compliance priority, this is allocation agreement, again, between the CDFI Fund and the CDEs. That agreement is making sure in that agreement the CDE is committing to certain activities, certain service areas, certain types of projects, and so the CDE wants to make sure that when they go out and find eligible projects, that the projects that they invest in are in accordance with that agreement and what they said they would do when they committed to the CDFI Fund. There's a lot of compliance that goes with these transactions, and for me, that's not the fun part, but the fun part is the deals. And I want to walk through the basic new market structure. We'll put some number to it. We'll use an actual deal as an example and talk a little bit about how the transaction is structured, how money moves during the compliance period, and then how the transactions are unwound at the end. And back a minute to some of the terminology that I introduced you to early in this presentation. So the structure that you see in front of you is the typical new markets deal structure, and there are several players here. So at the top, we'll go from top to bottom. You have the new market tax credit investor who's providing equity into the investment fund, and the leverage lender who's putting loans into the investment fund. The investment fund is just an LLC that's created for a new markets transaction. You can think about the investment fund as being the entity that's pooling the dollars from the investor and the leverage lender. There are transactions, like I said before, where the investor and the leverage lender might be the same entity, but they can also be two different entities. Through the investment fund, the investor moves the QAI, which we talked about earlier, into the CDE. So that's happening in sort of the middle of this diagram, the arrow that's going from the green circle or green oval to the blue box. That is the qualified equity investment that the investor is making into the CDE, and that's the activity that's really generating the tax credits. The CDE is then using those dollars to make two loans into the purple box, which is the project. Those two loans are the QALICBs that we talked about a little earlier. Those are qualified low-income community investments. And then the borrower or the project at the bottom, that is the Qualis B. Let's put some numbers to this. Same diagram. Now it just has some numbers to it to sort of bring it to life a bit more. And I'm going to walk through this in detail. My apologies if it's too slow, but I really want folks to be able to follow. So we'll start all the way at the top to the right. There's a debt to project that's coming from two sources. There's $1 million coming from the bank, and there's $1 million coming from other source, city grants, state funds, bridge loans, any other source. Both of those amounts are going, they're being pulled into the leverage lender entity. And that could be probably an LLC that is that the developer created, and it's just for ease of payment and organization. Those funds coming from the bank and the city state funds, those could also go directly into the investment fund. You don't need that entity in between, but a lot of times you do have that entity just because it seems like an additional layer, but it actually does make the transaction sort of smoother. Leave it as is for now, and say you have a bank loan $5 million and city and soft funds of $2 million that come together to form the leverage for the transaction. On the other side, at the top to the left, you have a new market tax credit investor who's putting in $3 million of new market tax credit equity. We just talked about the $3 million from the new market tax credit investor, the $5 million from the bank, and the $2 million from the city/state soft sources go into the investment fund. So you have a total of $10 million. That $10 million, the investment fund uses that to make a $10 million QEI into a CDE. QEI generates the tax credits back up to the investor. So new markets tax credit is a 39% credit. That 39% is taken off the $10 million QEI amount that you see in the middle. So this project will generate $3.9 million worth of tax credits. The CDE takes the $10 million of QEI and does two things. The CDE takes a fee of $300,000 that you can see going off to the left from the blue box in the middle. He's also making 3 different loans to the project. They're making a $5 million loan, a $2 loan, and a $2.7 million loan. It doesn't have to be complicated at the bottom, but often you see it this way, so I wanted to show you guys this example. The $5 million loan, the one they see here as the A loan, that actually traces all the way back up the structure to the $5 million that came from the bank at the very top right. The $2 million B loan, that traces all the way back up the structure to the $2 million city and state money. The $2.7 million C loan, that traces back up to the $3 million investment from the equity investment from the investor. The reason why it's only $2.7 million and not the full $3 million is because of the $300,000 fee that the CDE took from the transaction. So you have at the bottom, you have an A loan, a B loan, and a C loan. The A loan corresponds to hard bank debt. The B loan corresponds to soft debt from the city and the state, and the $2.7 million C loan corresponds to equity from the investor minus fees that were taken out. And talk a little bit in a more slides about cost and transaction costs and other CDE costs in a second, because I see those questions coming through. So that example makes sense. We'll go on to the next slide. So there's sort of two things that you are focusing on when you're trying to fill the gap that you have in your capital stack. Both gross equity and perhaps the most important is equity, and we'll get to net equity in a second. But gross equity is what you see here. This example is $10 million of QEI or $10 million of new market tax credit allocation. You see the 39% tax credits. You can see how much tax credits are being generated for the investor, $3.9 million in both cases. But your pricing is determining your gross new market equity. In the first example, your pricing is 77 cents off of that $3.9 million of tax credits, so you have gross equity of about $3 million. In this example, you have pricing of 85 cents, which is really sort of about where pricing is in today's market, and that 85 cents is generating $3.3 million of gross equity based, again, on the $3.9 million of tax credits that are being generated by this $10 million QEI in the project. I'll go back because I want to address the question that I'm getting about the C loan in the previous page. So the C loan, all the way at the bottom, the $2.7 million C loan, that does not have to be a loan. It very often is, but it could also be an equity investment. A lot of times it's easier as a loan because it's going to be a grant, so it's either equity or a loan. If it's going to be equity, then that means that the CDE now owns a percentage of the project because they've just made an equity investment to the project, and they're expected to get some sort of return based on their ownership in the project. So a lot of times the projects would rather have the equity, the funds coming from the equity investor in the form of a loan so that you're not giving up any equity ownership in your project. Loan rates are typically blended. So your $5 million loan from the bank at the top and the $2 million state and city funds, those may be at different interest rates, but usually the B loan, the A loan, and the C loan, all the way at the bottom, they're at a lower interest rate because they only have to generate enough interest to pay the two loans all the way at the top. Let me say that again in case that's confusing. Actual interest that you need to generate in this project, you only need to generate enough interest to pay the $5 million loan and the $2 million loan that are all the way at the top in the right corner. So even though there are three loans at the bottom, the interest rate at the bottom is probably going to be lower than the interest rate at the top. So there's no extra interest that's being created in the structure. It's just creating enough interest so that as the money flows up the structure, it's enough to pay off those two loans at the top that actually do require interest. The investor doesn't get any sort of cash for their new markets tax credit investment. Up to your project how you want that C loan to be classified. If you want the C loan to be classified as a loan or if you want it to be classified as equity. But if it's classified as equity, now you have another entity that has an ownership stake in your project. So most projects would rather it be a loan, especially since that it doesn't actually generate any additional money that's going to go in any other place within the structure. So moving forward, we talked about gross equity and just how pricing determines how much actual dollars the the same amount of new markets QI will generate. So net equity. Net equity is perhaps even more important than gross equity because net equity takes into account the fees of transaction. So there are a couple of different fees that are typical in a new markets tax credit transaction. This example here, example 1 and example 2 are they're the same numbers from the previous slide. So we're all thinking about this from $10 million of new market tax credit allocation, which generated $3.9 million of tax credits to the investor. So the placement fee is a pretty typical fee in the industry, and that is a fee that the CDE takes for providing allocation to a project. These fees can range from low 1% or 0%, high probably 10. I say that's really rare in today's dollars. Fee, so that's the $300,000 that you see in the first row, and then transaction costs. So there are a number of different players in each typical deal, and each of those entities has represent them in the transaction closing and negotiation. So you'll at the very least you'll have representing the investor, you'll have counsel representing the CDE, and you'll have counsel representing the project. If your lender and your new markets credit investor are not the same entity, then you may have another law firm that represents the lender. Transaction costs in these transactions can be high. You'll also have a separate accounting firm that will be putting together the financial model that reflects the transaction. I think transaction costs are usually the cost for legal and the cost for the accounting firm. There may be some other costs like recording costs depending on your jurisdiction. You'll have to get some of your typical due diligence done as when you're closing a typical real estate transaction. So there'll be costs for things like environmental, title, and those types of things. So we estimated those costs $300,000. That's the second line that you see there. Then there's the CDE asset management fee. So CDEs typically charge a fee every year for the 7-year compliance period. This is this $350,000 that you see here is it's a 50 basis point fee each year, but we're showing it as if it was all taken out on 1 year, so that you can see the total cost over the life of the transaction. So we that all together for each of those years. And then the CDEs have to do taxes and tax returns and audits. Their financials audited by accounting firms. That's about $10,000 a year. That cost is usually paid for by the borrower. Again, we're looking here at the 7-year cost so that you can see the entire cost over the 7 years instead of just showing you the cost over 1 year. So add all those costs up, then you can get the difference between your gross equity and your net equity. So in the first example, you went from $3 million of gross equity to about just shy of $2 million of net equity. And then the second transaction that was priced higher, you went from $3.3 million of gross equity to almost $2.3 million of net equity. This is a real project, and so I just wanted to sort of show you how new market tax credit fit in with that actual project. So in this project, there was a $5 million loan from a bank, about $3 million of tax credits, equity, a bridge loan, and some other fee and state sources that combined for the $2 million. So you had a total new markets allocation of $10 million. The developer also had $2 million of other sources for total sources of $12 million. And then in terms of the uses, these happen to be the uses for that project. But you can see that there were some fees and expenses of about $1.5 million, which I think maybe not all, but most of those were transaction costs and other costs related to the new market tax credit closing. And so it shows you sort an actual developer's budget and how the new market tax credits fit in. During the compliance period, how does the money actually move back through the structure? So for this diagram, it's best for us to start at the bottom. This is showing how money moves up through the structure during compliance. So starting at the bottom at the project, or new markets terminology, the Qualis B, and following the green arrows, because those are the only, those are sort of the new arrows that are relevant here. The project is paying debt service to the CDE. That's debt service on the A loan and the B loan, and I probably should have included the C loan here because that would have been part of it too. So debt service is being paid to the CDE. The CDE then uses that money to make a distribution. It's like 99%, and that's based on the IRS code. 99% of that money goes up to the investment fund. The investment fund only has one thing to do with that money, and that's pay the debt service that's owed to the lender. And the lender here had multiple sources, including a bank loan and some city and state sources. And that lender entity, which is usually a developer affiliate, will pay off the various lender sources each quarter or semi-annually or whenever the payments are due. So the money moves back up the structure. During the compliance period, either every quarter, annually, or every year, money is moving up that way. Then at the end of 7 years, you unwind the transaction. This slide's busy, but hopefully it'll all make sense. And this is a slide where it's better to start off at the bottom of the structure because unwind, you're sort of, you're undoing what you did before to put the structure together. We had there's an example, and my apologies, I should have used A, B, and C, but we didn't use that here, so let's just keep going. So say A loan here is $7 million, and that, again, represents the loan that came from the bank and the city-state sources. So say those were all 7-year loans. If they were, they're all due at the end of the 7-year compliance period. So the project borrower will have to refinance or find some other way to pay off this A note to CDE. That A note to the CDE gets paid off, and then the investor is going to put their interest in the investment fund. So the investor doesn't get any money. They've gotten their tax credits, which is what their part of the bargain was for this transaction. The investor no longer has a need to be in the structure. So they put interest in the investment fund, and they're putting their interest to either the sponsor or the developer. So now the investment fund, instead of being owned by the investor, is owned by the sponsor. So the sponsor, the project developer, pays off the $7 million loan at the bottom. The CDE, like enterprise, we don't have a reason to be in the structure anymore. The investor's not in the structure. We exit the transaction as well. So the developer is really the only person left, the developer and the lender. The developer now has the funds to just pay back that $7 million loan to the lender that's due. And then if they have the bank loan, city and state sources, then they pay off those sources, and everybody sort of exits the transaction. What about the B loan? So the B loan is forgiven. That's the money that flowed from the investment that the equity investor made, but there's nobody gets repaid that loan. So that loan is forgiven. That money stays with the developer. It can be a tax event to have that loan forgiven. So potential projects need to think about the implications of having debt forgiveness at the end of the 7-year period. But that's sort of how the transaction unwinds. The hard debt from party sources gets repaid. the money in the B loan or the C loan gets forgiven, the investor walks away, the CDE walks away, and what's left is the borrower and their project. Just puts, let's see, I just put some numbers to that. Yeah, this is exactly what I was talking about. So you can see the green arrows here back to the bank loan. The bank loan got paid back, or the A note got paid back to the CDE. The CDE dished it up to the fund. The fund paid it to the leverage lender because that's the only person that the fund owes. The investor's already gotten out of the deal. You see that purple arrow going up to the investor box or the bank box. And then the money is used to pay back the hard debt. If the loans were still outstanding, let's say the city and state loan was not a 7-year loan, it was a longer-term loan, that loan doesn't have to be paid off at the end of the compliance period. The same entities can stay in place, except the folks who don't need to be in the transaction anymore have left the transaction. So the bank has put its interest into the investment fund, so now a developer affiliate is the one that owns the investment fund. The CDE can also get sort of redeemed out. So now you've got 3 entities left in the transaction. You've got the project, the CDE goes away, you've got an investment fund, but now that's owned by the developer, and then you've got the lenders. So if you exited a deal where debt wasn't due back yet, it hadn't matured, if that can be longer than the compliance period of new markets, then you still have sort of a simplified new market structure where some of the entities remain, but the only entities that remain are the project, the lender, and an investment fund, but now an investment fund is owned by the developer. So that's how you sort of get out of or unwind these transactions at the end of the 7 years. I thought it might be helpful to just talk a little bit about what's happening in the industry right now. Our industry doesn't follow sort of a set pattern each year. It changes from year to year what's happening in the industry different times, and it's really driven by the availability of allocation from the CDFI Fund. So within 30 days, we hope there'll be a new NOAA released by the CDFI Fund. The NOAA is the CDFI Fund's Notice of Allocation Availability. That's the release of the application where the CDFI Fund asks CDEs to submit an application to compete for new markets allocation. So that should come out in the next, as of tomorrow or as late as 30 days. Once that comes out, there's a 2-month period for CDEs to submit the best application they can to the CDFI Fund. The fund will make awards of that allocation, hopefully by the end of 2017. So at the end of 2017, there'll be a new round of CDEs that have been awarded allocation that they can find eligible projects for. In the meantime, CDEs are focused on getting out the allocation that they were awarded in November 2016. CDEs are focused on closing transactions this year with allocation that they received at the end of last year so that they can demonstrate to the CDFI Fund that they're able to use allocation that they receive and put themselves in a good position for receiving allocation again, and because there are lots of projects that have been looking for new markets and waiting for the allocation to be made available. In terms of policy efforts through 2017, there'll also be a lot of focus among CDEs and others in the industry to protect the program and strengthen the program so that it'll be around, foreseeable future. I alluded to before, the New Markets Tax Credit Program is not a permanent program, so it is a program that the industry has to make the case for the case of the Congress, continuation of the program to Congress every few years, and there's definitely a focus on doing that now with suspected tax reform and other changes happening. So that's really sort of where we are right now as an industry. If you're a CDE, if you're a Qualis B that's looking for potential new markets allocation, the most important thing is determining are you a project that's really ready to go right now, or are you a project that would be in a good position to close in the early part of 2018? There are a lot of CDEs that are make commitments now for allocation that they received in 2016. So if you're a project that's really ready to go now, I'd say, market your project as aggressively as you can to CDEs. If you think your project might not really be ready till the end of the year, it might make more sense just based on the timing of the new markets allocation and awards to look out for when awards are announced at the end of 2017, and then to start doing the matchmaking process of finding the right CDE for your project and finding the right investor, and sort of putting your deal team together at that point in time. I got a question that I did want to answer about investors, and thank you for that question because I did mean to talk about that a little bit earlier. So the investors in this industry are, most of them are banks. There also are some insurance companies that are investors. There are some non-bank financial institutions that are investors, but typically a bank, an insurance company, or a non-bank financial institution. There are a couple of healthcare companies that are or have been investors in new market tax credit transactions. The list of investors is actually quite small in this industry. I'd probably say there are about 20 investors that I know of, and I'd say only about 10 of those are active every single year. I do know that there have been some investors that are starting to look again, or maybe even for the first time, at the new markets tax credit industry for investment, given some of the changes that were happening at the pricing and other things in the LIHTC industry. Some investors, a lot of investors on the bank side are community development institutions that invest in LIHTC credits as well. A lot of their investments are CRA driven, but there are some investors that don't invest based on CRA needs or Community Reinvestment Act needs. They invest just because they find the tax credits to be useful, or they like the types of projects that are done. Typically, I don't see individuals as investors in the tax credit. So that was all I had for new markets specifically. I did want to talk a little bit about policy. There's just a couple of short slides on that. I didn't get into too much of the details, but tax reform is something that this year, I think maybe it will happen this year. It definitely seems to be a priority for the administration and also for Congress. Tax credit programs are certain what will happen to those programs in tax reform, and new markets is in that boat too. It's not 100% clear at this point what the plan is for tax credits like new market tax credits, and the reason why it's unclear is just because not a lot has been communicated yet about what tax reform will really look like. What we do know on the slide is about lowering corporate tax rates from percent to as low as 20% or 15%. Tax rates being decreased may decrease the appetite for tax credits. we don't expect that the appetite for tax credits will go away completely, but it may mean that some of those investors that I talked to you about a minute ago may, their appetite for this particular credit or other types of credits may change over time. It's just, it's too early to really know how it's going to play out. I see the impact of tax reform as potentially being, there's potential threats and there's potential opportunities if there is a, rewrites or modifications to the tax code. Of course, the biggest and most obvious threat is just the elimination or the reduction of some of these programs, including the new markets tax credit. The other big threat is just that the advocacy or interest in the program, the desire for investors to be a part of the program could be diminished if tax rates are so low that investors don't feel the need to use tax credits anymore. Positive side, this does give us an opportunity to either expand the program or make the program permanent. New Markets Tax Credit is not a permanent program. We are in the second year of a 5-year authorization that we have. So there are 3 more rounds of New Market Tax Credit allocation that can be awarded before the current iteration of the program or the current authority that we have from Congress expires. So definitely be advocating for the permanence and expansion of the program, and that's why I posted the 2 pictures that you see right here on the right. That is Congressman Murray and Congressman Bernil, and they introduced legislation last month to make the New Markets Tax Credit program permanent and to expand the program. There is an effort in place to get that done, so we'll see what happens. I'm going to move on to the LIHTC portion of the presentation. This order, so the new markets presentation, I really just wanted to give an overview of historic tax credits, talk a little bit about that program for folks who are not familiar with it. Historic tax credits is not familiar to not similar to the new market tax credit at all. They're both tax credits, but other than that, they're not similar. So everything you just learned, you'll have to set it aside and think about this program in a totally different way. This legislation was enacted in 1978. It's a different part of the Internal Revenue Code. It's really an incentive for developers and others to restore historic buildings. It was created, there have been over 31,000 historic properties that have been completed. The way that HTCs are calculated are based on the qualified rehabilitation expenditures of a project. And the way projects can qualify for historic tax credits are 2 different ways. You can be eligible also for a 10% rehabilitation or historic tax credit if you have a building that was placed in service or sort of occupied, completed construction before 1936. That's the only requirement you have to meet to get the 10% credit. You just have to have a building that's older than 1936. For a 20% historic tax credit eligibility, you have to have a building that's a certified historic structure. And in a subsequent slide, I'll get into a little more detail about what a certified historic structure is. This credit is claimed in the year that the building is placed in service. All of the credits are claimed in that 1 year. There's a 5-year recapture period. During that 5-year period, the building must remain in use and it cannot change ownership. The credits vest over 20% per year, which means that it's not sort of a, if there was a recapture or something like that, it doesn't all, if you're in year 4, you can recapture the credits from the previous years because 20% has vested each year, so now there's only credits left from year 4 and year 5. Fair from the new market tax credit program in that respect as well. an example of how to calculate the HTCs is here. So if you have, say you have $4.5 million of qualified rehab expenses, and that's not every expense that goes into the rehabilitation of the project. We'll talk in another slide about what some of those qualified rehab expenses might be. But for now, $4.5 million of qualified rehab expenditures. If you qualify for the 20% credit, meaning you're a certified historic structure, then you can generate, based on that, you can generate $900,000 of HTCs. Your pricing might be at 85 cents, and that would mean an equity investment from an investor of about $765,000. And just to answer the investor question in case people are interested, I've seen some of the same investors in the new markets tax credit space as I've seen in the historic tax credit space, but I've also seen some investors that only invest in one of those credits and not the other. I'm speaking just on my own personal experience. I find that some of the non-bank organizations are a bit more comfortable with the historic tax credits, perhaps because it's a little more straightforward than new markets tax credits, and more clear on what you can use that program for. But some investors overlap and some of them don't. Just depends on what it is and extra appetite might be at that particular year. Things to think about for historic tax credits. There must be a qualified rehabilitated building. The Park Service is involved in certifying the plans for the 20% tax credit, so you have to get approval from the National Park Service to your development plan, and I guess maybe more importantly to your plan for continuing to historic nature of the building. The rehabilitation must be substantial, which takes into account the amount of dollars that will be spent on the renovation versus the value of the building. It is calculated only on the qualified rehab expenditures, and it's reported to the IRS by the taxpayer, but that's true for everything. Just an analogy for those who aren't familiar with the program, like I said before, for the 20% credit, the National Park Service is involved in that process. The National Park Service does designate buildings as being historically significant. So sometimes you will know even before you start to renovate a building or make plans to rehab the building that it is on the National Register or that it's been deemed to be of historical significance. But you don't have to know ahead of time. If your building doesn't have that designation, you can apply to the Park Service for it to get that designation, and then it would be eligible for the 20% credits. Still, rehab means the rehab cost has to be more than the base of the building and has to be incurred within a 24-month period. This is important. The project cannot place in service before the rehab, that last bullet point there. So if you have a building where you, maybe there's a small portion of the building where you have a tenant who wants to go there and you want to rehab the larger building, something to think about if it makes sense to have that tenant move in. Then you may have a building that's already placed in service because it's already being used for its intended purpose. So I definitely suggest talking to legal counsel about not you can do that, or if that would jeopardize your ability to take advantage of the historic tax credits. And the qualified rehabilitation expenditures a minute ago. These are the costs on which the historic tax credit value is calculated. So some of the QRE eligible costs include all your hard costs, many of your soft costs. Demolition is included, some developer fee is included as long as it's a reasonable amount. Taxes and capitalized interest, so there are a lot of costs that you can include in QRE. One of the biggest I guess sort of the most significant cost you cannot include in the QRE calculation is the cost of the building. And and as well as FF&E. So in some developments, depending on what you're building, FF&E costs can be really high, like in a hotel, for example. So it's a significant cost, but it's not a cost that's eligible for in QREs when you're calculating your tax credits. The National Park Service process has 3 steps. The National Park Service and the SHPO, which I didn't explain, but that's the State Historic Preservation Office. Many times the State Historic Preservation Office is your first line of inquiry about the significance of a building and your plans for rehabilitating the building. And many times, but not all the time, your State Historic Preservation Office and the NPS are on most same page about those type of things, but you would need to make sure you get approval from National Park Service because they are the sort of final say. So just because you have some approval from your State Historic Preservation Office about something that you can do in your building, I would say don't be married to that plan until you get sign off from the National Park Service that they're okay with it as well. So there's 3 parts to that historic process. The first one is just the evaluation of the significance. So it's just determination that your building is of historic significance. Sometimes the National Park Service and the State Historic Preservation Office are making that determination on buildings without being asked. And other times you can make an inquiry for them to evaluate your building and see, make a determination for you if it's of historic significance or not. Or you can sort of make the case as to why you think it is of historic significance. So once you get that sort of certification that it is of historic significance, that's your part 1. The 2 is the approval of your plans for renovating the building. So this is when you have your specs and drawings, and you have your development plan for how you plan to renovate the building and what it will look like after your renovation is complete. So that needs to be approved by the Historic Preservation Office, your State Historic Preservation Office, and it needs to be approved by the Park Service. Many times you can be sort of in the midst of getting that approval in place when you're working on your transaction closing, but most investors will not close on your transaction financing until they have confirmation that the National Park Service is on your plan for rehabilitation, because no one wants you to start renovating the building and then later on to get the news from the Park Service that you're not allowed to do something that you may have already started doing or may have already paid for. And the last piece of that process is the Part 3, and the Part 3 is when the Park Service actually comes to visit your project to look at it and to make sure that you did, in fact, do the things that you said you would do in the Part 2, and that those things are aligned and that you did sort of rehab appropriately based on the plans that you agreed to. Two structures of HTC, and I won't walk through these structures in as much detail as I did with the new markets tax credit structure, but I did want to just at least show the diagrams. So this is a direct structure that you see here. Really, you have 2 entities here. You have the tax credit member, which is investor. The investor is the 99% owner, and then you have the developer, who's the 1% owner. The developer can also be the managing member of this tax credit entity. That tax credit entity is the one that holds the building. So it's really just those 2 entities, the developer and the investor, and they own the building, and the renovation of the building is generating the tax credits. That structure. There's also a lease pass-through structure. Also has the same properties, but the setup is a little bit different. Here, you have sort of 2 main entities, and they're actually the 2 in the middle. There's the owner entity. I would think of that as the entity that owns the land. The owner owns that entity 100%. Then there's the master lease. Basically, there's another entity that leases the entire building from the owner of the building. Then the investor investor is 99% owner of the master lease entity. One of the benefits of this structure is that as a developer, the investor doesn't own 99% of your building. Instead, the investor owns 99% of an entity that's leasing the building from you. So depending on how you want to structure your transaction, the kind of collateral that your lenders may want, one structure, the lease pass-through structure, may work better for you than a direct structure. It really just depends on sort of what priorities are and how comfortable you are with sort of an owner of building that is involved in, or if you want the investor's involvement to be through a master lease instead. It was a significant piece of legislation that came out, actually wasn't legislation, it was guidance from the IRS that came out in January of 2014. It's a little dated, but I wanted to put it here because it did change quite a few things in the HTC industry in terms of how transactions are done. And if you've seen a transaction or worked on a transaction prior to 2014 and you see one today, it may be a little bit different based on this sort of safe harbor that came out. So again, this was released in January of 2014. And the IRS guidance here about to give investors some understanding of what a safe harbor would be for HC investments. Some of the backstory here is that there was a lawsuit where the IRS felt like an investor in a historic tax credit deal should not have taken the historic tax credits, and the IRS actually won that case. And so they came up with this revenue guidance, or this safe harbor, just to help investors understand what the IRS felt like was and was not appropriate when it came to structuring historic tax credit transactions. Some of the items that you see here are ones that are talked about in that safe harbor. Things like guarantees that the developer makes to the investor cannot be unlimited. The investor should have economic return should be based on the success or failure of the project. So the IRS really felt like the investors should have some capital at risk. The fees must be reasonable, and how to demonstrate the reasonableness of fees and things like that. So like I said, this is just an overview, but if you're looking at an HTC transaction, I do think that familiarizing yourself with the safe harbor and the things that are allowed and are not allowed is an important first step in making sure that you're thinking about the structuring of your transaction in the right way. And then last slide, I just want to sort of show how HTCs can be combined with NMTCs, combined with LIHTC. But I tried to keep this same example of new market tax credits that we had seen before, but make it a little bit simpler. So all the blue that you see, those boxes are all of the previous new market tax credit boxes that we saw in a previous example or slide. And then these sort of boxes are the historic tax credit transaction structure. And this green box is really the box where they overlap. This is where the project actually is, where the real estate is. So for the new market tax credit structure, the green box is sort of the Qualis B, but it could also be the sort of developer land holding entity for the purposes of an HTC transaction. So these numbers are just, illustrative, but I did want to show an example of how those two credits can come together within the same transaction. If you have a historic building that also qualifies for for new market tax credits based on being in a low-income track, they can use both of those credits in the same transaction. And this is the last slide. So unless there are questions, which I'm happy to take.
Shamika, we've been getting some terrific questions in through the Q&A panel, and while to see if there are some more that we can take. We still have a few minutes left, more than a few. So if questions, now's the time. Type them into the Q&A panel and we'll address them. Thinking of your question, just a reminder that this session has been recorded, and a copy of the recording as well as a copy of the presentation slides will be made available. It will be sent out to all attendees and generally within about 48 hours, using a link to let you know that the archive is available. Last but not least, when you leave the session today, you will be taken to a very brief survey form. We really appreciate getting your feedback on our live online events, and so if you wouldn't mind taking 3 or 4 minutes just to go through the survey form, we'd be very appreciative. And now for a quick check. Q&A panel. Let's see. Shamir, I'm not seeing any new questions that I can see. Did any come in directly to you?
I don't see any.
Okay. Well, I was talking long enough to give most folks time to type their question in, so I think we are good. Shamika, do you have any wrap-up words for us?
No, I feel like I've been talking for a long time. I guess I'll just wrap up by saying that hopefully this was a good sort of first course or refresher. There are organizations that support both of these programs separately. There's a New Market Tax Credit Coalition. There are New Market Tax Credit conferences that happen at least 4 a year. There's a Historic Tax Credit Coalition and several historic tax credit conferences that happen throughout the country each year. So if any of you are interested in sort of diving more deeply into these tax credits and whether or not they are a financing tool that makes sense for your organization or your project, this is really just an overview, but there is some technical information here. So if you feel like you have more questions and you want to better understand the programs, definitely there are resources available. And I would say a good step is to attend some of those conferences and meet folks in the industry and get a better understanding for how they actually work in deals.
With that, I'd like to thank Shamika, our primary presenter, and our behind-the-scenes question answerers, Leah Rogan and Sue Wilson. Thank you very much for attending. I hope to see you online again soon, another Enterprise Live Online event.